wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 189, and in this episode we are reviewing the performance of the financial markets during the 49th week of 2025, and that is from Monday the 1st to Friday the 5th of December. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where the Commerce Department released the PCE report on Friday after a prolonged delay brought about by the longest government shutdown in U.S. history. The key inflation measure came out lower than expected in September, which gives the Federal Reserve a further green light to lower interest rates. The Core Personal Consumption Expenditures Price Index, which excludes volatile food and energy prices, showed an annual increase of 2.8% in September, down from 2.9% in August, and lower than the Dow Jones Consensus estimate of 2.9%. The Federal Reserve uses the PCE price index as its primary policy tool to determine the level of inflation in the United States, and the Fed generally considers core inflation as a better indicator of longer-term inflation trends. Following the release of the PCE inflation report, the CME's Fed Watch tool is currently pricing in about an 87% chance that the Federal Reserve will cut interest rates during its last policy meeting of 2025 that is scheduled to take place this coming week on the 9th and 10th of December. Staying in the United States, according to ADP, which is a payrolls processing company, the slowdown in the U.S. labor market intensified in the month of November as private companies cut 32,000 workers during the month. The decline in November payrolls was in sharp contrast to the upwardly revised gain of 47,000 jobs in October and was well above the Dow Jones Consensus estimate for an increase of 40,000 jobs. The ADP jobs report has taken center stage in the past 2 months as the official employment report remains unavailable following the longest government shutdown in U.S. history. The official government jobs report for the month of November is scheduled to be released on Tuesday, the 16th of December, and should help to provide a more comprehensive picture of the U.S. labor market, but this unfortunately comes after the Fed's policy meeting on the 10th of December. Over to the Eurozone, where flash data from Eurostat that was released on Tuesday showed that inflation in the Eurozone stood at 2.2% in the month of November, marking a slight increase from the previous month. The latest consumer price index reading was a shade above the European Central Bank's target rate of 2% and also came out a tad bit above the Reuters forecast of 2.1%. Meanwhile, core inflation, which excludes volatile food and energy prices, this remained unchanged from the previous month at 2.4% in November. The European Central Bank last cut rates in June and has held its key deposit facility rate at 2% since then. The last rate cut coincided with Eurozone inflation hitting the central bank's target rate of 2% and was part of a rate-cutting cycle that brought interest rates down from a record high of 4%. On Wall Street this past week, the S&P 500 edged higher on Friday, securing its fourth straight winning day as traders digested the latest inflation data that could provide further incentive for the Federal Reserve to lower interest rates this coming week. The core personal consumption expenditures price index for September came out lower than expected, and the PCE report, which serves as the Fed's primary gauge for inflation, will give the central bank its final view of inflation before it makes its policy decision on Wednesday. Ahead of the Fed's policy meeting, the latest data shows that inflation remains mild, whilst the labor market is showing signs of weakness, and traders are now pricing in about an 87% chance of a rate cut this coming week. Stocks posted gains during the week, with the broad market index, that is the S&P 500, rising marginally by 0.3% before coming to a close at 6,870. Meanwhile, the 30-stock Dow Jones Industrial Average rose by 0.5% before eventually settling at 47,954. And last but not least, the tech-heavy Nasdaq Composite was head and shoulders above the other indices as it recorded a weekly increase of 1% before coming to a close at 23,578. In the bond market, U.S. Treasury yields rose on Friday as investors digested the much-awaited inflation report for the month of September, which came out lower than expected following a government shutdown in October and November. All said and done, the PCE inflation report has given the Federal Reserve a further green light to lower interest rates at its upcoming meeting this coming week. Ahead of the Fed's last policy meeting of the year, the yield on the short-dated 2-year Treasury note rose by more than 3 basis points to close at 3.56%. Meanwhile, the yield on the benchmark 10-year Treasury bond gained by just less than 3 basis points before settling at 4.13%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil was steady on Friday, supported by stalled peace talks between Russia and Ukraine, and the top side was limited by expectations of a supply glut in the markets. There are two opposing forces at play in the oil markets at the moment. On the one hand, the lack of progress in the Russia-Ukraine peace talks continues to drive prices higher, whilst on the other hand, resilient production by OPEC and its partners continues to drag down the price of crude. Markets are also focused on the rising tensions between the United States and Venezuela, as well as the impact of a possible rate cut by the Federal Reserve, both of which could boost the price of crude. The price of the global benchmark Brent crude rose by 49 cents to close at $63.75 per barrel, whilst the U.S. benchmark West Texas Intermediate crude rose by 41 cents to settle at $60.08 per barrel. In the precious metals market, the price of gold rose on Friday, driven by rising expectations that the Federal Reserve will cut its benchmark lending rate by a 0.25 percentage point at its upcoming policy meeting this coming week. U.S. economic data showed that inflation slowed down to 2.8% in September, whilst the labor market showed signs of weakness as private payrolls declined by 32,000 jobs. Additionally, dovish commentary from several Fed officials has further fueled expectations of monetary easing, with the CME's Fed Watch tool indicating about an 87% probability that the Federal Reserve will cut interest rates at its last policy meeting of 2025. Depending on the Fed's decision, gold is projected to trade at between $4,500 and $5,000 in 2026. The price of spot gold was on track for a weekly loss of just 0.4% as it came to a close at $4,212 per ounce. In the cryptocurrency market, the price of Bitcoin has dropped by more than 30% from its record high in October, underscoring the volatility that has come to characterize the cryptocurrency market. According to data compiled by CoinDesk, the price movement from previous cycles confirms that the current price correction is part of Bitcoin's normal operating pattern and could be the setup for another massive rally. Bitcoin dropped to a record low of around $80,000 in November, representing about a 36% decline from its all-time record high of around $126,000 that was hit in October. Bitcoin's price movement is often categorized into cycles, and the Bitcoin cycle refers to a 4-year pattern of price movement that revolves around a key event known as the halving, in which the reward paid out to miners is cut in half. According to CoinMetrics, the price of Bitcoin was negative for the week as it failed to hold above $90,000 and was last seen hovering just above $89,000 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where the overall rate of inflation, also referred to as headline inflation, this declined to 4.5% in November, down from 4.6% in October, and this was on account of a lower core inflation, which outweighed the increase in non-core inflation. Core inflation, which excludes volatile food and energy prices, declined to 2.3% in November compared to 2.7% in October, mainly due to lower prices for processed food items. Non-core inflation, which measures food and energy prices, this increased to 10.1% in November, up from 9.9% the previous month, driven higher by the prices of select fresh vegetable items. In the domestic foreign exchange market, the Kenya shilling appreciated marginally versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.41 compared to 129.86 the previous week. Meanwhile, the sterling pound was priced at 172.07 and the euro was valued at 150.85. And on the regional front, one Kenya shilling was changing hands for 27.39 Ugandan shillings and 18.85 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.24. The IMF has raised concern about the stability of the Kenya shilling, and in response, the central bank confirms that it continues to adopt a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $79 million for a grand total of $12.03 billion, which is equivalent to 5.2 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 9.24%, which is in line with the central bank rate at 9.25%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this amount stood at 9.9 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. And in related news, the Monetary Policy Committee is set to meet on Tuesday, the 9th of December, in order to review its previous policy decisions and to decide the future direction of the central bank rate. We expect that the committee will cut the central bank rate by 25 basis points down to 9% flat. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 4th of December, and the central bank received bids totaling to 52.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 220%. The central bank ended up accepting 40.3 billion shillings, and the results of the auction were as follows. The 91-day rate was flat at 7.77%, whilst the 182-day rate was stable at 7.80%, and the 364-day rate dipped by less than 1 basis point to average out at 9.36%. In the primary bond market, the Central Bank of Kenya held the auction for its monthly bond issue on Wednesday, the 3rd of December. The central bank received bids totaling to 53.1 billion shillings against an advertised amount of 40 billion shillings, representing a performance rate of about 132%. The central bank ended up accepting 47.1 billion shillings, and the results of the auction were as follows. For the first bond, which is a 30-year bond that was initially issued in 2011 and now has 15.2 years left to maturity, the central bank accepted 3.9 billion shillings at a weighted average rate of 13.32% compared to the bond's coupon rate at 12% flat. And for the second bond, which is a 25-year bond that was initially issued in 2021 and now has 20.4 years left to maturity, the central bank accepted 43.2 billion shillings at a weighted average rate of 13.61% compared to the bond's coupon rate at 13.92%. At the Nairobi Securities Exchange, during the past week, the equities market was on a downward trajectory, with the NSE 20 declining the most by 2.8%, whilst the NSE 10 declined the least by just 0.7%. This takes a year-to-date performance to gains of 44.8% for the NSE 20 and 38% for the NSE 25. The market's performance was mainly driven by losses recorded by large-cap stocks such as NCBA Bank, Kenya Commercial Bank, and Equity Bank, which declined by 7.8%, 4.3%, and 2.8% respectively. This performance was however supported by gains recorded by other large cap stocks such as Stanbic Bank, East African Breweries, and Absa Bank, which increased in value by 7.1%, 1.6%, and 0.9% respectively. In related news, Family Bank of Kenya has raised 8 billion shillings through a private placement that has brought in new shareholders and in the process diluted the ownership of existing shareholders. The private placement, which saw the bank offer new shares to a select group of institutional investors, was oversubscribed by 31%, with the investors offering the bank about 8 billion shillings against a target amount of 6.09 billion shillings. The bank said that the bulk of new shares offered were bought by fund managers, pension funds, insurance companies, and wealthy individuals. Family Bank has also announced that it plans to list its shares on the Nairobi Securities Exchange in 2026 and will do so through a listing by introduction. Up next is our topical issue, and this week we are looking at the government's sale of a 15% stake in Safaricom. The government of Kenya is planning to offload a 15% stake in Safaricom to South Africa's Vodacom Group. The sale will raise about 244 billion shillings for the National Treasury and will help to ease the dependence on debt to fund our persistent budget deficits. The funds received comprise of 204 billion shillings for the 6 billion shares to be sold at a premium price of 34 shillings each and an advance dividend payment of 40 billion shillings. The amount of 204 billion shillings is substantially higher than the market price of Safaricom shares, which were valued at 169 billion shillings as at Wednesday, the 3rd of December, when Safaricom shares closed the day at 28 shillings and 20 cents per share. Vodacom Group, together with its parent company, Vodafone Group UK, jointly hold a 40% stake in Safaricom, which is valued at about 452 billion shillings. Meanwhile, the government of Kenya's current holding of 35% is valued at 395 billion shillings. However, after the sale to Vodacom, the government will retain a 20% stake that is valued at 226 billion shillings. Other shareholders in Safaricom hold a 25% stake that is equivalent to 10 billion shares, which was offloaded by the National Treasury in March 2008 during the initial public offering. The government of Kenya has forfeited about 15.5 billion shillings worth of future dividends in exchange for an upfront dividend payment of 40.2 billion shillings based on its reduced shareholding of 20%. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the kingdom of God is within you. That is from Luke chapter 17, verse 21. Think about it. Thank you, and God bless.